The broadcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon, everyone, and welcome. My name is Aubrey McLaughlin. I'm the Director of Alumni Professional Networks for the University of Maryland's Alumni Association. We're excited that you're able to join us for today's webinar, Springing into Action, a series on financial wellness, presented by Rey Calvello, graduate from the class of 2008, and Tim Carroll, graduate from the class of 1987. This webinar is part of the Alumni Association's Professional Development webinar series, which we hope to provide thought-provoking and valuable content that will help alumni like you achieve your personal and professional goals. This is a 4-week series with information building from week to week. We are hosting this series every Wednesday for the remainder of May, all of them from 12 p.m. to 1 p.m. We have a lot of information to cover today, but we will be taking questions at the end. Feel free to submit any questions at any time using the question box located in the GoToWebinar control panel. Rey has been with Independence Planning Group since 2010 and has been in financial services altogether for about 10 years. Rey has built a niche with physicians, CRNAs, nurse practitioners, and physician's assistants. He enjoys establishing a process and sense of financial stability for their short-term, retirement, and legacy objectives. Rey also enjoys presenting to business owners and their employees through financial wellness workshops. Tim has been with Independence Planning Group for 10 years now. He is a registered representative with Park Avenue Securities and an agent of the Guardian Insurance Company. Tim works with individuals and families. In addition, he focuses on small to medium-sized businesses in the area of business maximization and succession planning. Tim utilizes his 25-plus years of experience in running businesses and taking them to the next level. And now we will get started. Rey and Tim, take it away.
Well, thanks, Aubrey, and good afternoon, everyone. First of all, Rey and I are real excited. This is Tim speaking first. Just real excited for you to join us today and take some time out of your busy day to have us, get involved with the Terps Helping Terps program here. So we want to welcome you to Wealth Steps, as you can see in front of you here. Wealth Steps is a program that we use typically with our clients that are largely business owners, HR directors, but also a lot of individuals. It's a financial personal wellness program that we use, and it's going to be a 4-step process. As we talk about, as Aubrey already mentioned, Rey's going to give you a little bit about the value that Wealth Steps brings, and then we're going to kind of just dive right into it at that point.
Excellent, excellent. Hi guys, my name is Rey Calvello, and the value added from Wealth Steps, this financial wellness workshop, will give you a personal, private Wealth Steps website. You'll see that registration on upcoming emails, or you might have already seen that. And it allows you to input your own financial information and receive a scoring summary from Wealth Steps. And you can use that by yourself. You can use that with your own financial advisors, or you can get a consultation with Tim and I to review that summary through Wealth Steps. That'll print out for you, so it'll be nice and clean for use. So make sure you take value and take use of that.
So a little bit about us, as you might see that again, Aubrey kind of explained who we were. My background, again, largely I dealt with business owners, and that's how I got involved with the Wealth Steps program. It is a program that was designed for business owners. We're looking at the Alumni Association here, and those of you on the call, it's kind of a large group that can really benefit from this, whether you're a business owner or an individual, and that's kind of my background.
And Aubrey kind of mentioned already a great job of kind of where I built my niche in business. Obviously, I enjoying working with families and anyone for these objectives. But really today, the financial financial wellness workshops have been really neat to take part of with other people. So
a little bit about who we are and our background real quickly. We work with a firm called Independence Planning Group, founded, as you can see, 1987. We have a number of advisors as part of our team, specializing in various areas of finance and business planning and individual planning, and as Rey mentioned, through the medical markets as well. So it's a little bit of background about who we are. We have a number of clients that are nationwide. We're not limited to our area of the Northeast. We have clients all over the country and in various stages of life, younger, older, retirees, business owners, people looking to sell businesses, a number of different people. So we're going to kind of dive into Wealth Steps a little bit. Just an overview of what it does. You'll see all these buzzwords in front of you, all these question marks. Back in the day, really how Wealth Steps got started was you would in the past, financial planning was pretty simple. Back in the day, you may remember an uncle, grandparent, parent, pretty simple what they had to do. They had a pension, they had maybe a 401k, they had certain plans. It was kind of, the plan was kind of laid out for them. There wasn't all these questions. Some of these questions will pertain to some of you on the call, some won't certainly. But nowadays, a little different. There's a lot more stuff out there that goes on. I mean, back in the day, there weren't cell phones, there weren't iPads, there weren't all these other things that were costing you money and things you had to navigate through, not to mention, what do I deal with? Some of the things you see on your screen weren't even issues for many folks a long time back. So what we do here at Independence Planning Group is we take all this noise and we kind of manage the reality. The biggest thing is, now the question is, how do you hear all this noise, all the buzzwords that are out there? How do you navigate through this noise that's out there? And it's kind of unfair to think that people can do this on their own. So the data that we have is pretty crystal clear that it's difficult and virtually impossible to do this by yourself. So this is where WellSteps comes in. Basically, we navigate through the noise that's out there. What we're going to introduce you to today is phase one of the whole program. Again, it's a 4-step process. That's why they call it WellSteps. What we're going to do is introduce you to today is the first step, which is protect your todays. And we like to consider you take care of your todays before you start worrying about your tomorrows. To the extent that you're protected against what or might happen today, that sets you up with some confidence that you can look out to your future, design your future financial life just how you want it to be. Step 2, which we're going to talk about next week in a little more detail, is to become a world-class saver. And this, again, helps you navigate through all that noise on the right side of your screen there. Focus on not necessarily chasing the rate of return and speculation, and maybe modify or manage your risk a little better, but let your future be dictated by becoming a world-class saver. And the amount you save, and we'll show you over the course of the next few weeks, the amount you save could be just as much as important or more important as the rate of return you're seeking to obtain. Step 3, which we'll talk about as well, now that we've kind of worked on protecting today's, becoming a world-class saver, we're going to say, where does all that money go that you've saved? Where should it go first? Into illiquid strategies, illiquid assets, or should it go into places where you can't go to get your money if life changes its mind on you without any kind of plan? We think that you should have an ample level of liquidity on your balance sheet within reach, so that if life doesn't go as planned, things don't get interrupted and come crashing down on you. So that would lead us now to the 4th step of wellness and the WellSteps program. So we want to make sure that life's debt-free, where you have no credit card balances past the end of each month, no car payments, no student loan payments. You live in a house that's the right size based on your overall economic situation, so you can move forward, build your own balance sheet without the drag of debt. So that leads you to
what those 4 steps bring, guys and ladies, are security, confidence, clarity, right? It's not just throwing darts with your eyes closed and getting to a point. Hopefully you reach that point. This will give you those 3 things, and in the end, you'll have a financial balance approach to make sure you get to your goals and know and see the math to get to where you need to be down that road. So here's taking a closer look those next 4 weeks again, and we'll start with the first step today. This was more of an overview. Make a quick transition here to the first slideshow. Sorry for that little hesitation there. So today, protect your todays, right? And we're going to talk about this because really people kind of bypass this. Insurance is not an exciting thing, a topic of people that really don't want to talk much about. But starting here is vital and critical to pieces of your financial foundation. It's pretty much the roof of your financial house, making sure that when those bad days do come, you're positioned to kind of at least alleviate some of that stress in life that will happen if you're not protected correctly. And there's 3 rules that you should be aware of in order to be able to make those best decisions possible around your personal insurance portfolio. So to begin, let's look off into the future, right? Age 65, maybe the younger. People starting in the workforce might be age 70 or maybe even older. And imagine that you're about to retire. Maybe you have accumulated this $1 million, okay? Or maybe half of that, or maybe 5 times or 10 times that. Doesn't really matter. But our industry typically, has consumers looking down the road 10, 20, 30 years from now, And while that's important, right, you have to have some goals to be moving in that good direction so that one day you can retire. It's important that no matter what life has in store for you, there's going to be different life events that occur. We want to make sure retirement or those goals are uninterrupted and successful in order to be able to enjoy the second phase of your life, which is after you stop to work, which we're going to talk about may be a long, long time with today's life expectancy and stuff like that. We work a certain amount of years, and 20, 30, 40 years of work, and now we're expecting to maybe be in retirement for 20, 30 or more years with that pile of money that we're saving. So hopefully the income you're making is increasing over time, all right, and your ability to live your life is also set. Some of what you earn aside for your tomorrows, which is critically important part of finance, right? That's the saving rate. One day out in each of your futures, right, you'll stop working, you'll go from a person at work to relying on the balance sheet and being able to use that asset or nest egg, as they say, to fund everything for that time period. So that this $1 million here, right, is just merely a representative of your financial picture. It might look at what it might require in order to provide you with a successful exit strategy from the workforce. Whatever that number is for you, or if you're close to it, maybe you need to review that, or younger people have to kind of get that savings rate and see that calculation to get where they need to be. Would you consider spending in retirement principal and interest in the first 5 years of retirement? Or would you think it might be proper and safe and prudent to spend all of it in 10 years, right? Or maybe 20 years. That's where that question mark is. How long am I going to have to spend this money? Or how long do I have to maintain this nest egg so that I don't run out? And that's the biggest problem with people trying to figure this out on the back end. So it's not just about accumulation, right? When you're doing planning for your future, it's about saving, but also what's the plan for distribution on the back end, which many in our industry and consumers are not doing at the same time during accumulation, is the distribution scenarios down the road. So again, no one really knows how long retirement will last. So those several decades could bring a lot of different probabilities. Maybe the stock market drops a substantial amount. We experienced that 10 years ago. And how do you alleviate that pressure, right? But in our community here today, we don't have that crystal ball, right? And we have to have the ability to plan for that distribution no matter what, and make sure that nest egg can work for you. We're going to go back to that concept of distribution and accumulation at the end of our time today. You'll see some of that concept and consider the important question that sometimes, like I said before, gets buried by our industry. It's not something that has really been given good strategic advice around. The savings part, accumulating money has been we've been great in our industry doing that. But by the time the session's done today, I think you guys will have a better picture for what it takes to get to retirement and how to be successful, safe, and have that secure retirement, no matter how long it has to last, right? So before we get to that phase of retirement, let's talk about what today's discussion is really about, and that is making sure that we are prepared for those things that could occur along the way. That could interrupt, affect, minimize, or even destroy that possibility of ever getting to that retirement life scenario, right? So, and that's where that protect your today scenario comes in. So what comes first? This is a little easy game here. Which comes first when you get dressed in the morning, right? And you have a shoe and you have a sock, but it's pretty simple. It's just an analogy, is that first you put your socks on and then you put your shoes on, right? We don't do that reverse, and we just look awkward and people look at you strange, might be concerned about you and for your future. But typically the sock goes on and then you get your shoes. So the same thing in finance is that we want to address our financial life and balance sheet in an order. And there is an order if you want to have something that's a balanced approach to getting things done. I use this analogy really for the financial choices that everybody makes, the products we buy, what's given us through work, and the decisions that we have to make when different life events occur. But there is a hierarchy when we begin to explore through the overview of wealth steps that we really want to remind you all of this morning. So we'll move on to the first step here.
The first step you're going to see, the protection rules, first step is protect first. There's something that should come first, and what that basically amounts to is that the first order of business for everyone as they consider a financial future is first consider what could happen today, rather than thinking in terms of a financial event, say 10, 20, 30 years down the road or even longer. It's critically important that you consider what could happen today, something that could interrupt and maybe make unavailable to you the financial future that you're in search of. So rule number one as it relates to protection is that the first order of business that we find is when we work with our clients is the first thing on the agenda that we talk about every time we meet. It's our obligation to make sure that our clients are properly protected for today. So that in the back pocket, they can look forward to a financial future, their financial confidence that says, hey, even if something unexpected or even catastrophic happens, it's already been considered. It's already been implemented and proper insurance installation is in place. So things happen in a correct order, and there's a certain order that it can happen in. So everyone that's on this call, you have 4 financial domains that make up the entirety of your financial picture, as you see them in front of you there. I mean, you have a balance sheet. Everybody has their own personal financial balance sheet. You have assets on your left. Those are things that you own. You have the right side of the balance sheet over there, which are liabilities, things you owe, such as mortgage, debt, whatever it might be, loans you may have. And the difference between what you own versus what you owe is in your net worth. Pretty simple accounting, philosophy that's out there. And how the balance sheet comes to be populated is through cash flow. And that's what you see on the bottom. That's your financial foundation of your financial home here. And that's basically each decision you make year in and year out, the money that you come in, that creates your balance sheet, keeps everything up afloat. Now, your balance sheet, therefore, is critically important. The cash flow that populates the balance sheet is even more important. And that what we've just added here is the protection, basically the umbrella that you see over top of your financial home. It's important that you have that umbrella. You have a roof over your balance sheet so that can serve as an impenetrable layer of protection, something that will safeguard the very tool that provided you with that retirement life that you had moving forward. Things happen in life that are unpredictable. You read about in the paper, you may in fact have happened to you, and you may have to consider those events that can happen. And this visual of safety, insulation, protection, protecting your assets, your balance sheet, your cash flow, that sets up our clients the most important first step in a financial decision-making process. So let's think of it this way. There's a little visual for you. Think of it this fashion. You're in an automobile accident. Not your fault. You're not severely hurt, or maybe you are severely hurt, but maybe you have a broken leg. Pretty simple scenarios probably happen to some of you out there. But maybe the trauma of the accident itself has caused some other issues. Maybe your heartbeat starts to beat irregularly. You're being wheeled into a gurney into the emergency room in the triage unit, local hospital. They're waiting for you. The ambulance is called ahead. They're talking to the triage team about your symptoms. You have that broken leg. You have that irregular heartbeat. But what do you think the medical unit's going to focus on? Would it be to set your leg in a cast as a first order of business, or would it be to make sure that your heart is stable? Even leaving your leg neglected, perhaps, even risking the chance you might limp for the rest of your life, wouldn't it make a little more sense to get down to the heart of the matter, so to speak? And that's really what's also important in regard to protection and insurance decision making. First order of business, but that inside what lives, the hierarchy says, well, shouldn't you just take care of the most important issue first? What are the biggest rocks? What's the most significant financial threat that you face? You should be about making sure those are taken care of thoroughly and properly first. And that's taking care of the heartbeat of your financial journey first. Now, it brings us to our first poll question. We're going to ask Aubrey to bring that up today so you'll see it. We actually have an interactive part here. So while you're enjoying your lunch and your sandwich or whatever you're doing out there, we're going to ask that question. You're going to see a poll in front of you there, which we're going to ask you to rank these top 5. And again, this is the point where you'll see the poll button, and maybe Aubrey can take us through that at this point.
Yes, so for those of you that are connected from a laptop, you will be able to select one of these answers to the poll questions here. We do have some responses coming in. I'm going to keep this open for a couple of seconds here, so those of you who think you know the answer, feel free to make your choices, and we'll get this closed in about 10 seconds here.
And again, you see them in front of you. If your home's destroyed, you long stay in the hospital, permanent loss of income, your car is stolen or totaled, or maybe you're just sued because of some negligence on your part. All those are different things that could come up.
All right, so these are our responses.
Excellent.
All right, so basically you can see what we have there, and Ray will move on to the next slide. And if you were to look at this from a smallest to largest threat perspective, it stands out far and away above all is financial risk from your standpoint. What would it cost you most if something were to happen to you? And permanent loss of income is one thing we see.
So really 61%, we're just reading off the poll, is voted correctly. 22% said hospitalization, get sick. Next would have been get sued, lawsuit at 9%, and loss of home, loss of car, 4%. So fairly close. I think the majority obviously got it correct, and that's great. So thanks for your participation on that. Excellent job. And there'll be 2 more polls coming up throughout.
So second piece of protection rules, which Ray will take from here, is about full replacement.
So protection rules, we talk about this, and we just saw why in those largest to smallest threat. And the ability to earn a paycheck, that's the biggest concern. People might not think about it, they bypass it, or they select it on their group benefits or individual policies, and they don't review them. But paychecks, okay, are what allow you and your balance sheet to grow, and your ability to go work or go to work is the most important asset for you financially, is to show up, okay? And it'll continue to be that driver that will build that balance sheet, provide that cash flow for you, your business, your balance for your family, and allows you to make those financial decisions to someday, obviously, to retire or sell that business and enjoy that life that you've always envisioned, okay? So if you suddenly took your earned income out of the equation and stopped it altogether, think about that, or turned the valve down on it forever, everything changes, right? So therefore, it must be protected. You know, what about foreclosures, bankruptcies? These all occur from disabilities that last, you know, on average, a good amount of years. So we want to make sure you guys are thinking about that in your future and when to review that. So these are all important aspects in your insurance portfolio. I hope you were able to see that that list, and we want to make sure that they're all made perfect for you, okay? I advise you as to operate, like Tim said, that member of the triage unit inside the emergency room. There's definitely steps to take when that happens during emergencies. And same thing in those steps there. We would follow those largest threats first, down to the smallest threats. So now the question becomes, how much insurance, right? We all like to talk about, you know, how to save some money, right, on insurance. But what is the actual correct amount, okay? How much of your house would you actually want to replace if it got destroyed, right? We wouldn't replace half of it. We would probably want to replace everything the way it was. And that's typically what we do. What part of your car do you like the most, right? You want to save the back end instead of the front, or the vice versa? No, we usually like full replacement for that as well. Is costume jewelry really acceptable in the replacement of the real thing? No, you're going to want that full value, and making sure that you know, that important piece to your family is brought back to life. So if you look at all your insurance decisions that you've made in the past, there's always been a connection between the amount and the value of the property being considered, right? And there's an equal amount of insurance compared to the fair market value of the asset or property in question. So that makes sense, doesn't it? It wouldn't make sense to have a nice luxury piece or nice luxury automobile and have your insurance designed for not a luxury vehicle. And you'd have to drive a moped to work, right? That's not going to work out. And we laugh at the notion that even though it's far too often how people make decisions, some people think like that, around the amount of insurance or how much they pay, which is obviously has to be an important part of it, but they want to maintain their lifestyle and have full value of what they've had. Insurance policies that you have, that you pay for, should do their job, right? They should fully replace the home, fully replace it, tornado hits or a fire. It should be replaced like nothing ever happened. They should replace that car, the same car, and the jewelry or the artwork or what other form of property there is, and it should be fully replaced, right? And at least that's what you should aspire to do. Get as close as you can. There shouldn't be any calculation or consideration to what's needed. It's really just more of an alignment between asset value, like we show here, and the amount of protection. This is also true with your life value, that most precious asset, like we just did that poll, your ability to earn that income, right? How much of that income should be replaced if you could never work again due to a death or disability? And we say all of it, right? We have an economic value to ourselves, to our families, to our businesses, and our employees. We say all of it should be fully replaced if we can do that. So there is a correct amount of insurance to have in every area of your insurance portfolio. And the number one thing that you should be searching for is how much insurance can I have? Okay, it's a different thing than most people when they go to the marketplace is how much do you want or how much do you want to spend? We say how much can I have? And at least you know what the maximums or close to that is. So how much insurance is available to me? And that answer gives you the certainty that full replacement coverage will be in place. So the cost comparison, right? This is always the balance of where we have to find, comes far too often is that this debate of, I think I'll just self-insure versus transferring risks to insurance companies, right? People say they're insurance poor. So people forego the insurance or have limited levels of insurance. And what that does is puts their whole balance sheet that we showed you in those 4 interdependent sections, the protection, assets, liabilities, cash flow. It puts you at risk for those assets to be depleted. And what that does is also puts your cash flow at risk. Okay, so we want to have that discussion of transferring the risk. This picture, really you should kind of maybe draw this out or take a picture of this. This fork in the road, this conscious decision we make probably every year when we redo our premiums or car insurance policies or whatnot. What portion of the risk do I want to assume? Do I want to own? And what portion of the risk do I want to transfer to others, right? And to transfer off my balance sheet to people who are the business of managing risk, right? They actually do that for a profession. So it basically should look like this in your mind. You should be able to accept small upfront risk, typically known as deductibles, right? Or out-of-pocket costs. And the large catastrophic events, which are the actual most important, should have full replacement maximum coverage. And that should be offloaded to insurance companies. If you were to reverse this and you were to have minimal coverage, then that means you're asking for more of the risk, right? And you're self-insuring to a larger amount to an extent, and premiums are higher, and the insurance company is not even involved in protecting your future as they should be. So let's make sure that when you get to this fork in the road, every time you consider insurance, that there's this proper relationship between the risk that you're assuming or your family or your business versus the conscious decision to offload that risk to others. So, and that comes to also saying that you should be reviewing these policies every couple of years, right? Some people, they push those off and never see them for 10, 15, 20 years sometimes. So make sure you review your insurance policies every couple of years.
What that's going to, we want to give you a couple case studies to kind of make that point a little clearer perhaps regarding self-insurance. And these are 3 different case studies that we're going to kind of go over with you, kind of give you a little visual to what we're talking about. Let's look at these 3 separate case studies and measure whether accepting the risk or transferring the risk makes sense and what the financial impact might be. Let's say if a claim actually occurred. Many people think in terms of premium or cost of insurance as being the roadblock, but unfortunately, many other people actually come to realize that by not transferring the risk to an insurance company, their financial future may look dramatically different than what they had intended. So let's take a look first here at case study number 1. Simple concept. Many of you listening out there today likely own a home. And let's look at the financial impact of self-insuring versus transferring that risk to a homeowner's insurance company. So here's the basic fact pattern that we're going to use for all 3 case studies today. So consider that you're 35 years old. I know it doesn't pertain to everybody out there, but we're trying to generalize this. You have 30 years out in front of you before you retire, basically. You're saving about $1,000 a month. You've already set aside about $35,000 a year, and you hope to be able to earn 7 or 8% on your nest egg, enjoying a 4% after-tax rate of return. If you did that over the next 30 years, and there's your nest egg sitting out there on the upper right-hand side of your screen, $1.281 million of compounded accumulated wealth building results. Now, let's suppose that you're self-insured, you have no homeowner's insurance, and that home that we show there, $200,000, which you probably wouldn't have if you're living in the Northeast, but that's another story. That $200,000 home was destroyed by some kind of natural disaster, tornado, flood, hurricane, fire, something something out there, but it caused that house to disappear, and you have no insurance, so therefore you have to turn to your balance sheet in order to replace the asset. Now you see that here we're in this example making it year 9. You've accumulated over $200,000 of wealth at that point, on your way to a very successful financial future. But look at the dip that occurs when you have to take that same 200 grand off your balance sheet and rebuild that house out of pocket using your own balance sheet assets. You virtually have to start all over again. So that by the time the retirement begins, instead of 100 or 1,280,000, you now are otherwise enjoying your nest egg with a value down to 825,000. So that's a $450,000 difference in this hypothetical scenario. Again, that's assuming the total loss of a home in year 10 of your financial journey. Now let's take a look at case study number 2. You're driving down the road. You're thinking about your life, how great your life is. I'm a Maryland alum. I have the top 2 lacrosse programs in the country, rated number 1 going into the NCAA tournament. Had to get that plug in there. But anyway, you're having a great time. All of a sudden, though, something distracts you. Cross the center line, you run through a red light, and you're responsible for injuring or perhaps even killing another driver in another vehicle. That's not something that's pleasant to think about, obviously, but every evening in the news or every morning in the paper or online, wherever you get your news from, these events occur. What financial impact would that have? And you may actually know somebody that this has personally happened to, perhaps. So let's now use the exact same set of facts. A 35-year-old, 30-year time horizon for retirement, $35,000 already saved, $1,000 a month going in your balance sheet for future retirement purposes, and a lawsuit happens. Let's say you're at fault, there's a $500,000 that's awarded to the victim that has to come off your balance sheet. So this event doesn't happen in year 10 like your home did. Let's just say in this scenario it happened in year 22. You've been doing everything perfectly, you're following your playbook, operating in a disciplined fashion, you're making sure that the annual savings has occurred or actually increasing on an annual basis. Everything's just working fine to that point, and all of a sudden, in an instant, in an intersection on the way home, perhaps due to bad weather, whatever, everything has changed. And here's the impact. It goes from 1.3 million basically down to $569,000. All that capital has been eliminated from your balance sheet. Again, perhaps you have no control over it whatsoever, but these possibilities can happen. Let's take a look at case study number 3. We talked about your most valuable asset earlier during our poll being your ability to earn an income. We're going to show you a case scenario where that kind of proves that point out a little bit in our view. What if you're injured or you become sick, you're unable to continue to work? Let's look at that impact in retirement someday. Again, fact patterns unchanged. You see this, you've seen this the last few slides back. But if you were to lose your income, and you could have had, say, $6,000 or more a month coming from a disability insurance company, you could avoid this calamity. However, disability in year 14 would force you to turn your nest egg over for living expenses. Now you build up $300,000 or $400,000 of capital that's earmarked for your financial future, but now you have to repurpose because of an illness or an injury or disability to pay bills to provide your lifestyle, and all of a sudden permanent loss of income. Now you can see that you won't make it. The person won't make it. The capital runs out, goes red, and whatever retirement dreams there have been, you disappear in an instant. So whatever death or disability of a permanent nature occurs, you can see why we regard this as being the most significant financial threat. Instead of a $2 million or $1.2 million, it's now a negative number resulting in a complete financial failure.
So those are great case studies. To summarize, all right, a home, automobile accident resulting in a lawsuit, an injury or an illness, or even in death, where income that's been rising has been expected to continue to rise. That stops forever, and this is what this is showing. Looking at the total losses of these simple possible scenarios, and they happen a lot. These are the results of self-insurance, okay? These are the results that should be avoided by us, by you, by insurance business companies, business owners. When things like this happen, it's virtually impossible to overcome, right? So that's why we want to prepare. And what good planning, what good insurance protection portfolios planning amounts to is that when homes are destroyed, the insurance replaces it, like we discussed. When lawsuits occur, your balance sheet and your cash flow are protected because the insurance company steps forward and settles that lawsuit on your behalf. It comes to making sure you have the right coverages. And if you can't work due to illness, injury, or death, that there's an amount of cash flow or capital that recreates for you or your family, the life you otherwise would have created, and what you have, what you're envisioning for your future. So what really drives these troubling statistics is the time value of money. which is not really talked about lots in when people are making financial decisions. It's not just the loss of a house or the loss of a ring or the loss or the cost of a lawsuit itself. It's the loss of those dollars plus the removal of those dollars from your financial picture forever. Okay? So it's the loss of those dollars plus the removal of those dollars from your financial picture forever. It's the $200,000 home that's no longer appreciating on your balance sheet because that $200,000 that might have been an investment has to be moved out of that investment to replace the home. The $500,000 to settle the lawsuit obviously is no longer compounding towards your future retirement years. It's been interrupted and redirected to take care of that victim. So proper consideration to the time value of money is critically important in properly assessing your insurance decisions. And to be fair and balanced, the same thing is true with insurance premiums, right? So when you pay that insurance premium, you don't hope that you someday have a claim, right? I don't like paying premiums, and most people don't. You don't hope that your house burns down or that you have a hospital stay or that you get sued. So if what happens is what you hope for and that you never have a claim, then you've lost those premiums, plus you've lost those dollars and the use of money on those dollars. So just like the claim itself, it's not just the loss of a single dollar, right? It's the dollar plus what it could have done inside your financial picture over time. And that calculation's never discussed. So what it could have grown to be worth on an after-tax basis is really the question we want to think about. So now the correlation should be, well, what carries the biggest cost? Is it the claim itself plus the lost use of money? Or is it the payment of premium plus the lost use of money that sets up the biggest financial impact over time? Here's what that looks like. Okay. So this slide here is if anything significant happens along your financial journey, like we described, home being destroyed, severe car accident, lawsuit, permanent loss of income, then the self-insured approach here devastates nest eggs and has tremendous reduction in the remaining retirement income available to you and your family or business. However, all right, visually, if you take the insured approach while you pay those premiums, while those premiums have a cost of the premiums itself, plus the lost use of the money, what you're protecting is the bulk of your remaining retirement income. It's always, always better to insure, and there's never a point in time in your life when self-insurance would serve you well. Okay?
So what if the insurance has no cost? Think of it this way. How much would you want? While premiums have to be paid, there's steps you can take and then should take to lower the actual cost of the insurance. For instance, as you see here, you can lower the cost of insurance by taking a look at your group benefit plans at work, wherever you may work. Again, with a large group of insurers, pooling effect has a lower cost on what you actually pay out of pocket. So we always recommend that you analyze all the benefits that your company provides and see how you can be plugged into your insurance portfolio. Most people, however, they require more insurance than just what's provided by their company. So there are other ways to lower costs. You can adjust the timing, the amount you self-insure versus when you transfer the risk to an insurance company. Maybe if you became that world-class saver in step 2, which we'll talk more about next week, and you have an adequate level of liquidity, which we'll get to in step 3 of this workshop, you have the ability to self-insure a little bit more. The higher your deductibles, the lower your premiums are, and by self-insuring a little bit more on the front end, you'll be able to still maintain and maximize the coverage in the back end while lowering your annual insurance costs along the way. So as you look at your balance sheet and you live your life and you make other decisions around your finances, these can have an interdependent effect, a rippling effect on your actual insurance costs. Perhaps having your car insurance and your homeowner's insurance and your umbrella coverage all with one carrier gives you more of a batch or a discount on that. If you're driving used cars as opposed to brand new cars, your insurance costs could be lower, and you're in a home that's the right size in keeping with your overall financial situation. Your homeowner's insurance premiums will be in line with that as well. You want to work with an qualified insurance professional or team of professionals that help you assist you in keeping your out-of-pockets down significantly.
So in the world we live today, everyone on the webinar, even family, friends, should have their policies, ample documentation stored where Mother Nature can't affect them. We all get in trouble. So have your kids on a Saturday morning work with you to go around the house, create a video of everything that it is. You're going to need some kind of documentation if your house does burn down to the ground. You want the insurance company to replace everything that was destroyed, that you're paying premiums to cover. That will someday require proof of ownership if that claim ever actually happens. So that video and the policies themselves should be stored in an electronic vault so that if a hurricane rolls ashore or tornado, everything you need to verify to rebuild your balance sheet has been unaffected by these events. Platforms like Living Balance Sheet that we have, this or other things out there, other applications that allow you to store these important documents so they don't get into harm's way. So here is what it looks like when we arrive on the scene. Far too often when we come to meet with a client or business owner, and people have the opportunity to have all of these elements as part of their insurance portfolio: car insurance, homeowners, umbrella, disability, medical insurance, here at work, long-term care, legal documents, life insurance, and if you're a business owner, a buy-sell insurance policy or agreement. And this is what the majority of people we meet look like on their current overview. So we're going to take components of this. We're going to take some polls now, 2 in a row, and 2 different topics based on what we see here, and ask you these 2 questions coming up. So go ahead, Aubrey, and we can pull that up.
Okay, so the second poll is up. Which of the following is true regarding long-term care? Again, same as the first poll. Please select one of the options, and then we'll give this about a minute here to collect responses before we share the results with everybody.
A couple of these things that we see, long-term care isn't something that's necessarily discussed a lot with a lot of, thought of with our clients. We're just using this as an example because it's kind of more food for thought in some of these. So it affects people at different stages of life, and it's kind of what we're trying to show with this poll question here.
And really, long-term care affects it affects multiple generations in decision-making. That's why we want to make sure that people on today kind of get an idea of what it affects.
All right, it looks like we've collected almost all responses. I'm going to go ahead and close this poll up, and then those are the results here.
Excellent.
And the correct answer is actually all the above.
Great job, guys. Yes, 69% said all the above. So that, everyone's pretty much on track. 19% said 44% of people reaching 65. So let's move forward to the next poll, which is more business owner appropriate.
Yeah, this one here that Aubrey's going to bring up has to do with, it's really more towards business owners, but it's food for thought for everyone. You may have somebody else that owns a business, or family member perhaps.
And if there are business owners on the call today, there is a buy-sell agreement checklist here on the handouts that will also be distributed after in an email. So that's very useful.
Okay, and the poll is up. We are collecting responses. We'll leave this open for another 15-20 seconds or so, just to make sure. I know it's a lot of text to read through, so just want to make sure we give everybody enough time to make their selection.
Excellent.
So anyway, yeah, that's so what you're actually going to find. I don't know, Aubrey, how are we doing with the answers at this point?
We have a little bit more time before I close this up. I'll give it another 10 seconds or so, and then we'll be able to see the results. Okay.
Kind of a trick question.
It is a little bit of a
kind of a trick question because they all apply. So
You're all right.
Need to be addressed, and as Ray mentioned, there's a PDF that's at the end there where one of the PDFs you can see with the business, the BuySell Checklist, which you can go over that. So that's something else you can pull. One of the resources we have that's available to you. When we try to work with our clients, we try to get them to the far green. That's ultimately what we're doing with their overview when we talk about all the protection items. That's one area we try to get to. So the last protection rule we try to work on is lifetime coverage. So insurance, we've determined it should come first, Socks before the shoes, emergency room, that kind of thing. Triage the problem first, and it's a matter of full replacement. So now what's next? Is there any difference between really being a 35-year-old having an automobile accident or somebody older having an automobile accident, where does it really matter how old you are at what point? That's the reality. So is it our view, in using example one here in liability coverage, is it's not going to really matter how old you are. So it's really, you're going to want it for a lifetime, whether you're 35 or older for that matter. So then example two, life insurance coverage, same thing. It sets it up. It looks quite differently. In the issue of life insurance, most people think of life insurance being a temporary need, something they won't benefit from or no longer use, for a certain age or when they retire. But the reality is, this visual, this is how different types of insurance, in this case, term insurance works. It protects you for a certain period of time, but that's the less likely time when something's going to happen to you. Whereas opposed to later in life, where the actuaries say something's more likely going to happen to you, that's when you need the coverage, and possibly a permanent plan would be a better way to go, where it'll last as long as your assets last and as long as you last. So that's one thing to go back. We went back to the very beginning of our time together today, and we're going to end today with a concept that may be new to you, but will be very important and allow you to understand how self-insurance versus transferring risk altogether, and how you should maximize or can maximize enjoying cash flow of your ultimate nest egg.
So this whole thing about insurance and nest egg and why permanent life insurance? You have term life insurance, permanent life insurance. They're all different types of products and assets. So consider this. This is your nest egg shown here. It could be $1 million that I spoke of at the top of our time together today. It could be 1.2 million that we used in our case study examples. It could be something less than that or something much more. Whatever you have in retirement, it will drive your lifestyle for an indefinite period of time, as we said before. And we want to make sure it lasts. So when I posed the questions to you earlier, would you spend your nest egg in 5 years? Most of you would probably say no. When I said, well, maybe 10 years, you'd probably think of spending it all, principal and interest, in 10 years. You probably thought no. And then say 20 years, you say, well, maybe, but even then, I might live more than 20 years. So I don't want to run out of those assets. So the unknown duration of retirement causes people to become locked out of their wealth. Okay, and that's the biggest thing we see. It causes them to hoard their wealth in their nest egg and live off of the interest or dividend income of that portfolio. So in this example, the $1 million is 5%, would kick off $50,000 a year. You'd pay some tax on that, and you'd live in about $35,000 net of taxes for your retirement. That's about $3,000 a month. And that's what $1 million that can't be spent, but merely serves as the engine of your life produces. Okay, $1 million produces 50 grand, and then after you pay taxes, it ends up being 35 grand. And that's the way it would be each and every year. And if you live 20 years into retirement, that's coming out to $700,000, as you see down there. We're going to talk about what that feels like in some of the subsequent educational sessions next week and the week after. But I just wanted you to pause for a moment and think about how you would put your nest egg to work at retirement, given the fact.
So let's take a look at another example moving forward. If you were to, another option would be, what if you, instead of what Ray just talked about, let's talk about principal and interest, and you decided to live off that. The term insurance disappears, and you hadn't purchased permanent insurance, and you retire with the same $1 million, but now you have the ability to spend not only the interest but the principal each year, to spend down principal and interest during the time of retirement. You pour out your balance sheet, out your life completely, but instead of $50,000 in this example, we provide you with $80,000 of income, $15,000 tax, $65,000 net income compared to $35,000 net income. By the 10th year, that income has grown because taxes have gone down to $70,000. By the last year, in the study period, you could actually see the income is up 80 compared to still $35,000 cumulatively over the same 20-year period of your life. You've been able to spend and enjoy your life. It amounted to $1.4 million compared to only $700,000, 2 times the life. A retirement that's twice as good. Think about it. Twice as good, and yet now you find yourself perhaps 85 years old and your balance sheet is somewhat empty. Maybe your spouse is still alive. Maybe you have children or grandchildren or benevolent causes that are important to you. And this empty balance sheet, this empty cylinder that you see on the screen, is something that stands in the way of an obstacle people having to, have a better retirement life. So the question is, what would you choose? And it's an obvious one. So obviously it's pretty an obvious answer. Would you choose option 1 or would you choose option 2? Pretty obvious answer, pretty pretty standard to be there. So the question really is, why permanent insurance? Because basically you can refill the bucket is really what it comes down to. Is once you deplete all your assets, you can now increase your permanent insurance. You can now have the permanent insurance that's there that can be utilized for different assets. The life insurance reports back into your balance sheet, and for those children, grandchildren, benevolent causes that have that may become important to you as you grow older. The reason we're mentioning this to you today is to get to do your decision making along the way as it relates to insurance is really what it comes down to. So we're not always it's not always about the premiums themselves, but it's about the loss, use of the money that you nest egg someday when you retire. However, properly constructed insurance be something that would allow you to live longer and have that further insurance, further money in retirement. So what we want to do is we're going to try to circle back here and kind of wrap things up today a little bit as we move forward. In honor, to look at your time, is just to kind of go over the action steps that we need to take moving forward. Basically, let's just summarize today a little bit about what we got into as it pertains to life insurance. Figure out what you're worth as a money-making machine. We call it the human life value. Find out what the optimal level of life insurance protection amounts to. Start with the term insurance, get your today's protected, create a game plan to create some or all of the type of life insurance that won't disappear before you do, and then implement all that. It's available. Review your insurance portfolios, life insurance program periodically. Make sure something happens to you, your family will enjoy the same life you've otherwise provided to them if something should happen to you.
And then for disability, trying to apply for maximum monthly benefits, do a review of your benefit options at work, seek tax-free lifetime protection so that your claims come in tax-free, and review as a household as your income increases. Liability insurance, making sure you review with your property and casualty professional, update that annually, adjust your deductibles to be lower cost, and maintaining maximum liability coverage is very important to your balance sheet. And then wills and trusts to your family, vital. Many people pass this on till too late, and that's huge for making sure that you're protecting your assets and your family and who you want it to pass to. So review that regularly. And those are the action steps that are really going to put you on the first steps to making sure that you can organize yourself. And so we're going to open it up to questions. This is our contact information, direct numbers and emails. And also make sure that you take part in the WellSteps website that you have access to, making sure you can get your own summary if you would like. And also, please remember there's going to be a survey being sent out to you afterwards. Just let us know how we're doing. If you want a consultation, there'll be access to put that information in there. But just let us know what we could do better or what we're doing great, and that would help us for the subsequent weeks. So now it's time for some Q&A, and Aubrey, you can take over and we can go forward.
Awesome.
We have about 5 minutes, I guess.
Yeah, thanks so much, Ray and Tim. Like they mentioned, we will take some questions now. If you do have questions, please be sure to type your questions into the box in your GoToWebinar control panel. I will also mention there are a couple of handouts from this week. Tim and Ray were kind enough to share with you. So those are for you to use and take back with you and refer back to. I will also be sending out those handouts in a follow-up email along with a recording of this, Ray and Tim's contact information, the WellSteps account, and all that good stuff. So stay tuned for that. I'll give just a couple of minutes for anyone who has any questions that are top of mind. I realize that finances sometimes are one of those topics where you need to take it all in and process it and then have questions later. And so that's completely fine as well. So just a couple of minutes here.
Nope. Right, and that's part of as well. We certainly understand that too. And part of what we mentioned is, you will be getting information sent out. The PDFs are there, the surveys there. You can reach out to us for no-cost consultation for any TERP that's out there. That's why we're doing this for the TERP community. And just real briefly, while we wait for a question or two, if they should come in, just as a reminder, this is part one of a 4-part series. And today is probably the least glamorous of the four topics, but we find it important as far as the first step of wealth steps.
Correct.
Next week, we will be talking more about becoming a world-class saver. A lot of folks find that as a more exciting topic, perhaps. And these sessions, as Aubrey mentioned, are being recorded. They're available to you. If you can't make all the sessions, you can't make next week, or maybe somebody could make this week, they're available as well.
And yeah, if you know someone or a colleague that hasn't heard of this, please forward this information to them.
Absolutely.
So it looks like you have a question. Go ahead.
We do, yes. So we do have a question. How does permanent life insurance replenish your assets?
Well, basically, there's a couple different ways, and there's a couple different ways it can work. But basically, what will happen is if you spend down some of your other assets first, you can utilize the permanent insurance as an asset and basically become the beneficiary of your own policy while you're still alive. There's a number of different ways that can happen. Either pulling from the death benefit or the cash value and the asset that's built within that.
And to add to that, it's the most important part of that strategy, or if it makes sense, is the permanent death benefit part of it. Allows you to, if you're married or have a business or whatnot, allows you to spend other assets more aggressively because you have the death benefit that's permanent, will always be there. Plus, life insurance is the only insurance that is guaranteed to pay out. And so that will replenish with a death benefit payout tax-free to your heirs. So you're able to take a more aggressive approach in spending down your assets if that sits next to your retirement assets. Thanks for the question. Excellent question.
All right, perfect. I'll allow just a couple more minutes. I know we're coming up on the top of the hour here, but Ray and Tim, is there anything else you wanted to cover before we wrapped up here today?
Not necessarily. Just again, as part of this program, you have the ability to go on and create your own Wealth Steps site and begin the program on your own, just to kind of check your own score, see how you're doing as part of the Wealth Steps program.
And some people might think, well, where's this information going? That's all private. That cannot be seen. Once that's your information, like I said, go through those 4 steps yourself, keep it for yourself, take it to your advisor, have a discussion. We want to make sure you have a resource, and that website is excellent. We've had great feedback from people that used it or maybe went on to use it for themselves and had some results. And you can always sign up for having us walk you through it if you have questions.
Absolutely, absolutely. It looks like we've covered all of our questions here today. As Tim and Ray mentioned, please feel free to contact them directly if you would like more information or wish to discuss your own personal situation. A follow-up email will be going out later this evening with things that we covered today, as well as some the Wealth Steps website and the recording for today as well. So thank you so much, everyone, for joining us today, and we hope you'll join us for week 2 of this series happening next Wednesday, May 16th at 12 p.m. Have a wonderful day, and go Terps.
All right. Thanks, guys.